Good evening, everyone, and welcome to the 30th session of the AIM Prime program. Today's session is on financial planning and simulation. And our speaker for today is Dr. Premnath. Dr. Premnath is scientist at Polymer Science and Engineering Division at NCL, and he's also Director Venture Center. So, handing over the session to you, Dr. Premnath.
Okay, good evening, everybody. Can you hear me, Mukta? Hello, can you hear me?
Yes, sir, we can hear you.
Okay, good. No,
Hello.
yeah, and yeah, can everybody see my screen as well?
Yes, just full screen. Yeah.
Okay, no black boxes, right?
Yeah, no.
Okay, good. Okay, good evening, everybody, and let's get started right away. First thing I wanted to ask is how many people got a chance to sort of at least browse through the two Excel sheets that were sent to you or loaded on the Google Classroom? How many yeses on? Any more? Okay, that's fine. If you didn't understand, did you just get a chance to browse? That's all I wanted to know. Okay, so not too many people have done it. So maybe around 10 have gone through it. Okay, so let's continue. So today, the plan is as follows. By the way, Shruti was to join me today in the early part. My colleague Shruti Devasali, who handles our equity and investing and funding portfolio. But I am going to try and do it today in language that is sort of more comfortable for scientists and engineers. And she might have been uncomfortable with some of that because she's a professional chartered accountant. So bear with me if some of you also have that orientation. Okay. So anyway, so let's begin. So the first thing I'll do is a little bit of a recap of finance. Then I'll take a little bit of a time to just understand how investors think of investing and what implications it has for you raising money and what determines value in any given proposal that you put to them, what determines it, and how can you plan for it. And then we'll take a we'll take as a story of a new startup and then see how its finances evolve. One of the things we find useful here for many new people who are just understanding the startup world is that there's some very simple questions of how really does it really happen in terms of where does money come in, where does it go, how is it used, how are shares issued, how does the shareholding change, what is dilution, all kinds of simple things which I think people struggle to understand, which I'm trying to just give you a picture in the form of a storyline, and then we'll close today with some instructions for the coming next 2 weeks. Okay, so we'll begin with this. So all of you should have by now received these two sheets. One says one titled illustration from the investor's lens. It has two it's a workbook. It has two sheets. One of them is two things we'll try and cover. One is the investor funder perspective, and another is about cash flow discounting. And the second will be an income expenditure statement simulation, where we look at the evolution of a startup and do a small exercise on sensitivity analysis. Okay, and that is to just give you a feel for these sheets. We will see how far we can take it depending upon the time that's available today. So let's quickly dive into some recap first, and then. So Sujata has spoken to you about this already, so I'll briefly just mention it. Whenever you are looking at financial statements and the cap table, which will be very important for you, the shareholders table, the share progression chart is also important, how it's going to progress over time. So those are the only things I'm going to focus on here. So as Sujata told you, there's something called a balance sheet, which is a statement of financial standing. It is a snapshot as of a given date. In India, it is 31st March, right? Profit and loss account, as it's called in India. Outside, it's sometimes called income and expenditure statement, or a statement of financial transactions. Is more like a movie rather than a picture. It's over a period of time. In India, it's 1 April to 31st March, right? And cash flow statements, which again are like, it's like a movie. It's from 1 April to 31st March. In not-for-profits, it's called receipts and payments. And what this is showing you is cash as it's coming in. A simple thing to remember is the moment you invoice somebody, in your income statement, in your income expenditure statement, that will start showing as an income, although money has not yet come in, for example, to you, right? On the other hand, the cash flow statement would record that payment when the money actually comes to you in your account books, okay, in your company. So so the implications are that cash flow statements become very important wherever you have a situation where cash takes time to come back to you. So there is a potential cash flow problem, and there are many businesses which are such that you have to wait for money to come in. Becomes quite important for you to plan your cash in a much better way, and just a profit and loss account is not good enough. You need to have a cash flow statement, right? And the fourth bullet here is the share progression chart, which basically says how your shareholders pattern, how shareholding pattern is changing over a period of time. So these are the four things that are important for all of you to know. Let's understand a little bit more. Here are some important expense categories that I'm putting down, right? I've modified the language a little bit to suit some of us, or most of us are scientists, engineers. So this might be a little more relatable, and also many of you will apply for grants. So this aligns with some of that. So the first category is one-time expenses, capital expenses, and the second is recurring expenses. In government nomenclature, you will see it as capital expenses and revenue expenses sometimes, right? And in recurring expenses, so it's quite easy to understand it's one time versus recurring, right? And recurring, there's one category which is a fixed recurring, and the second which is a variable recurring. Okay, the fixed recurring is what depending on whether your volume of work keeps going up and down, it doesn't matter. It will keep it'll still be a cost. Whereas a variable recurring is something which will vary as your volume of work changes, right? And this kind of a classification is quite important and useful for many reasons. And one of the most important is that very often company startups find that they will they put their expenses on the fixed recurring side are very high, and they're not able to bring it down as needed, or scale it down whenever cash situation is bad, and therefore they keep burning money without really having the money to burn, right? And therefore fixed recurring is definitely something you have to be very careful about. As you've heard before also, one of the top reasons companies shut down is because they run out of cash. Okay, it's insolvency and not bankruptcy. Okay, that means you still have assets out there, but you don't have cash at hand to pay salaries, to make things work, and so on, right? So the real challenge there is to manage cash well. Okay, and one of the key things to do as a startup is always ensure that your fixed recurring costs are relatively low. So what comes under those categories? So one-time expenses, all of you can understand, tangible things like land, building, equipment, instruments. Intangible like technology, fees, and so on. And fixed recurring costs could include rent, utilities, general services hired, managerial salaries, especially the CEO salaries come here, okay, and marketing, biz dev, and so on. And variable recurring costs could include supplies, raw materials, distributor or sales margins, labor, manpower, external services. A few points to note here. First of all, most you'll find investors are not happy about you at the very early stages investing in land building and so on. They would prefer you to rent space and get going, demonstrate your business and so on, and not really allow you to invest much resources here. Okay. The second point I mentioned was that overheads, you want to ensure that it's always under control. And one of the things which, especially giving, being really going overboard in terms of offices, utilities, all this kind of costs can really hurt your company in the very early stages. So you need to be really, really slim as far as costs are concerned. Okay. You will notice that many of your projects, grant projects, will focus on this variable recurring cost. They're willing to support you for this, right? Maybe they'll give you some money for equipment. Like BIG might give you up to 10 lakhs or 15 lakhs for that, but not too much, right? Most of your expenses are expected to be out here. Okay. And of course, a lot of your, this is where you need to raise your own money or to often fund all of this, which many grants and all will not cover. In most cases, some cases they will cover, especially at the very, very early stages. Okay. Okay. So this is a picture that we will use in the Excel sheet. So keep this in mind as well. We'll come back to questions a little later. And I've just also put down a few major cost categories here. So simple things to understand are on the right-hand side first, which is cost of operations, which includes the cost of manufacturing, right? Which I think even Sujata talked about. There's a cost of finance, which is if you're taking a loan, you're paying some interest. That's some money which you have to pay out from your company. Cost of using government services and assets is taxes, right? So this you will always see very often. When you're looking at an account book, when you're looking at the profit and loss account of a company, you may not see this item there, which is cost, the one-time costs or the costs of procuring assets. Okay. The reason is that it gets capitalized, it goes on the balance sheet rather than in the profit and loss account. But when you're looking at accounts at the early stages, especially in the context of a grant, which might be funding some of your equipment costs and so on, you may need to track this as well. And so I'm going to use a version where I'm going to focus primarily on cost of operations and some of these, cost of assets when I do my Excel sheet. But please remember that the accountants will do it slightly differently. Doesn't matter. At the end of the day, it is all okay. You'll also find things like depreciation, amortization. The simplest way I think about it is this, that see, if you were to rent your equipment, you would end up paying a rent on equipment, right? And it'll show up as a cost. Now, if you were investing your own money into buying your own equipment and running it, it doesn't reflect a cost on your expenses side, right? Because it's your own equipment. But you need to account for that in some way. And that accounting happens through a mechanism of allowing for depreciation, right? So it's essentially a cost of using your own tangible assets. By the way, this is my own language. I don't expect the accountants to accept that, but this is essentially what it is. And the same way for intangible assets, which is amortization. Okay, so simple way to understand this, and this gets factored into your expenses and therefore gives a better picture of how actually the mechanics of your business work. I will not consider these during my calculations. Sources of funds. So early fund inflows for startups. These are the things you'll often see, right? You will see equity investments, some soft loans and advances, some debt, perhaps. If you're already at revenue stage, some sales income. If you have some money you're put in a bank account for some time and it earns an interest, it might come up as miscellaneous income. Maybe some prize money, which is sort of treated like income. You might have to pay taxes on it, right? Unless it's a government thing, which they say that it's tax free. And then grants, right? Now, these are the inflows that are coming in. Of this, you will find that the profit and loss account focuses primarily on this, right? The income expenditure statement focuses on these: sales income, miscellaneous income, prices. These ones often we will see it reflected in the balance sheet. And grants is actually an interesting category. As I told you before, grants is somebody else's money that you get a privilege to use. So it only is reducing your expenses. So to some extent, to the extent they allow, you are reducing your expenses thanks to a grant. Okay. It is not an income, and neither does it go on the balance sheet, except to the extent that you have to return back to the government. If you're holding that money, you'd return back if you're not spending it. Okay. Or anybody who has given you a grant, right? So we will focus on these blue things out here. That's what your primary focus will be in the very early days, and then we'll see how things move. Now you could think of these, so that you saw two statements which were of the nature of a movie, right? Which are with time. It was for a fixed duration for one whole year, from say 1st April to 31st March. So these are the two statements: income expenditure statement and the cash flow statement. So how do they look? So the income expenditure statement has income minus the expenditure. So income is from operations and investments that you make, minus the expenditure, and you get something called earnings before before interest, tax, depreciation, and amortization. And then you reduce your interest, depreciation, amortization, you have profit before tax, reduce your tax, and you have profit after tax, right? Very simple to understand. This is a structure that we will use for our simulation. The cash flow statement, on the other hand, goes as follows. There's cash at the beginning of the year. There's some cash that you're consuming, it's increasing or decreasing due to operations, some due to investing activities, and some due to financing activities, right? Investing could be like you're buying some assets, or you're going and putting it in FD. Financing could be the money that's coming in through equity or loan, whatever it is. So these are two different things. And then at the end, you're left with some cash at the end of the year, right? So this is how the two sheets are, and we are going to use the one on the left. Okay, so for today's exercise, I'm going to use the one on the left. That is the one here. I'm going to ignore some things like income from investments for simplicity, just to understand, everybody understands it. And then remove things like interest, depreciation, amortization. I don't want to complicate matters. I'll keep it simple. We'll just focus on the profits and maybe a little bit of tax. Okay. And the idea is not to be accurate to the dot, but to get a larger feel of how the things work. So I don't want to complicate the thing by putting too many details, because then you don't understand the mechanics of it. Okay. You start getting into too many details. So avoid the details for the moment, especially if some of you are already familiar with some of this. Ignore the details. Let's look at the big picture. Okay. Now here you can also see on the right, I will be including some of the costs, one-time expenses in expenditure in the illustration. And I will also use, I will assume that there is no hold up in the money that you're supposed to get, and money comes in very, very quickly as soon as you invoice somebody. So we'll just assume a very simple system where there's no backlog of payments, no steady state system primarily. So we'll look at a year on year, whatever the cumulative loss is. That means whatever, suppose there's a loss and you keep adding year on year a loss, the total number as an indicator of the money that you need in the company to pay for that loss, right? So I will not worry about things which are, say, held up with a distributor in inventory and so on. I will just focus on understanding the cumulative loss and treating it as a measure of how much money I need in the company to overcome that loss. Okay. And so that is what I'm going to do in the sheet today. A few more concepts. Unit cost, right? So unit cost is basically the total expenditure incurred by the company to produce, to store, sell one unit of a particular product or service. Okay. And that in our nomenclature roughly translates to the fixed recurring cost plus variable recurring cost divided by the units produced. That is, so you're not looking at the one-time costs, you're just looking at the recurring costs and divided by the units produced. Very often as startups, you'll hear people asking you, what's your BOM, right? Which is a bill of materials. And the bill of materials is essentially the cost of materials and components per unit. So it's a subset of your variable recurring cost. Understood? So your variable recurring cost consists of many things which will change depending upon how many pieces you make. One of them will be the cost of materials and components, which is your BOM, right? And there's another thing you might hear, which is COGS. This one here, cost of goods sold. In our nomenclature here, we are talking about COGS as just being variable recurring costs that I talked about here, or direct costs in that sense, okay, including whatever it takes to run your to produce that so many units that you plan to produce. Okay, note that this is not per unit. Okay. Okay, now I'm coming to a little more difficult concept, but don't get worried if you don't follow this exactly in this slide, because you'll follow it definitely in the Excel sheet. Okay, so let's talk about a concept. And this concept, by the way, I'm using it to understand concepts of valuation, how it changes with time and so on. My intention is not to say that this is the only way to do it. Okay, this is one way to learn about it, and then what you do with it is up to you. Okay, but it is very good to explain certain important principles of how investors look at your company. Okay, so that's the reason I'm going to use it. So the concept of time value of money just means that if I have 100 rupees today, and after a year, you know, I somebody is giving me that 100 rupees, that 100 rupees will be worth a little less in value terms than the 100 rupees I have with me today. Why? Because if I had it with me, I could have invested it in say an FD, earned some money, and it would have probably become 105 rupees. Okay, so I have lost that opportunity to get that 5 rupees more on that 100 rupees. Therefore, it is worth a little less to me in 1 year's time. Now, if that money was to come back to me after 2 years, it would be worth even lesser, because another 5% I could have earned, and therefore maybe I would have got roughly about 110 rupees I should be getting, but instead I'm getting 100 rupees. So its value is a little lesser coming after 2 years, right? So there is a value of money has a time dependence to it. Okay, it also depends on one other factor, because value is not is something which is perceived by a person, right? The person who is the owner of the money, the value that he sees in that piece of, in that money, depends upon that person's perception of value, right? And you can easily understand that a person who is, say, happy with who's today focusing on, say, making money on a FD at, say, maybe 6 to 7%, for him, the alternatives are a lot more. Like share market is an alternative, right? But somebody who's already in the share market, who's, say, making 15 to 22% of interest, for that person, the alternative that they might be seeking with their money might be something that earns a lot more money. Okay, so that is something which you must keep in mind, which is that it's a value is a different concept. Okay, and than just the cash in its current terms. Value, on the other hand, has a time dependence. It also depends upon who is perceiving the value. Okay, now how do we capture that in numbers, right? So let's take this example here. This equation just says that here is a cash flow which comes in year 1. If you divide it by 1 plus a discount rate, it is called the present value of that particular amount. So if it's 100 rupees that is coming after year 1, and this is, say, the discount rate is, say, 10%, then you're dividing it by 1.1. So the value goes down from 100 rupees to 100 divided by 1.1. Okay, that has happened because it's 1 year old now, right? It's one now. Same thing after 2 years, it would have become 100 divided by 1.1 to the power 2, and so on. And that's how you'll calculate present value. So this number here is called the present value. And if you add the present value of a continuous flow of money that is coming, cash flow coming on year 1, cash flow coming on year 2, and so on and so forth, then you would get what is called a discounted cash flow, right? And that discounted cash flow gives you a sense of what is the value of this cash flow stream in year 0. Any questions at this point? Did people understand what I said? Anybody struggling with it? Yeah, by the way, you can download it, use it, please, whatever the Excel sheet, right? Can I ask if anybody has any difficulty understanding what I've said? Yes. Okay. So first thing, we will get into this a little bit more, right? Let's just repeat this a little bit. Here is a stream of funds, cash flow CF1, CF2, that means first year, second year, and so on and so forth. This number CF1 divided by 1 plus R is called the present value of this CF1. That means if there was 100 rupees cash flow in year 1, you discount it by 1 divided by 1 plus R, right? That is, if it's 10%, it is 1 divided by 1.1, and you will have a number which will be present value of that number. So that number 100 rupees, which is coming 1 year from now, is worth 100 divided by 1.1 today. Okay. That is what this is telling you. And if it's 2 years, the cash flow that is coming at year 2, which is CF2, divided by 1 plus R to the power 2, that's 1.1 to the power 2, is the present value. Okay, so the present value for any number, you can calculate a present value by seeing how far away in the future it is compared to today, right? So first year, second year, so that present value, there are multiple present values out here. Okay, now you can accumulate all of that, because all of that represents money that will come. Say there's a factory which is producing money every year, which is the cash flow that's coming out every year. Now that money stream is what your company is actually worth, right? But you have to correct it for time to say what is it worth today, and that number is the discounted cash flow that you're seeing over there, which is the sum. Okay, so this is a simple concept out here. Now the NPV is where you there is a formal definition for it. I don't want to get into it too much, which is actually explained here, but let me just say that in the very first year or 0th time, you're going to put some money in, right? That will be the investment, and which I will show you in the FD simulation just now. Okay, that you have to subtract from the DCF in order to get net present value. Okay, so net present value is net of the investment that you put in at any given time, right? Simplest cases, you put in 0 times, say 100 rupees, and after 1 year you get 100 rupees. You'll correct for that and reduce the investment that you put in, and that becomes NPV. Okay, it turns out that when your NPV is 0, that number of R which gives you NPV is called the internal rate of return. That's just for academic reasons. Don't worry about it. IRR is basically the return that you're getting out from any given investment and the cash flow. Okay, yeah, inflation, don't worry about that right now. Let us not, this is any cash flow. See, you're just saying that you're getting some money out every now and then, and how much is it valued today, right? Inflation is a different concept, where when you go and use that cash somewhere, right, it's less and less valuable at that point. Okay, just because the prices are going up, the costs are going up. That is a different concept. Here what we are doing is we are trying to say, if you as a company produce so much money in year 1, year 2, year 3, and so on, what is it worth to me today? Because when an investor is looking at it, he's thinking about it. I have this much money, I have these options to invest in. How do I compare investment option 1 and 2? That's company, Vaibhav's company and Bala's company. How do I compare the two of them, right? I will just go by the fact that, for my 100 rupees, which one produces the highest value. Okay, and that I'll calculate using this. Okay, so that's what I'm going to come to. Okay. Okay, I hope I have addressed some of these questions. So we'll come back. If you haven't understood, just flag it again. I will come back to it at later point, but we'll wait till the Excel sheet and then we'll see. So now we'll go to this first Excel sheet. I'm going to stop sharing and start that Excel sheet, and then we will discuss it a little bit. Okay. Okay, so let's look at, this is a different one. Yeah. Can you see my sheet? Somebody needs to tell me. Mugdha? Neha?
Yeah, we can see it.
Okay, good. Okay, so you are seeing a sheet which is titled CFD. You can download it from your Google Classroom as well. Okay, so here is what I'm going to show here. So the first thing, let's look at the ones in white first. Okay. Here is a situation where I've just taken a case where you just happen to have cash inflow coming in the first year 100 rupees, second year 100 rupees, third year 100 rupees, fourth year 100 rupees, and fifth year 100 rupees. Okay, so this is the cash flow sequence. Okay, imagine that you have a machine which churns out 100 rupees every year. That's what it is. Okay, now the question is, what is that 100 rupees worth? This machine worth, which can churn out 100 rupees every year. So if I took the total of that, it'll just be 500 rupees, right? And you would think that it's 500 rupees, but the fact that it comes later means that it is worth a little lesser. So let's see how much lesser, right? So I take the safest investment you could have made. Okay, and let's say this 100 rupees you were to put in a government of India bond, right? And it's at about 3.55%, let's say the interest rate. In which case you will find that I can calculate the present value of this 100 rupees. So this 100 rupees after year one is worth 97 rupees only. Okay, because it has been divided by that 1 plus 3.55%. Okay, it becomes even smaller after in 2 years, because you have now, it's twice that you had to discount it, right? And even smaller in third year, even smaller in fourth year, even smaller in fifth year. This number is called, so 97 is the present value of 100. 93 is the present value of 100. Okay, it's a present value of 100, today's value. Okay, at 0 time, right? Now you add all of this, because it's a revenue stream that you are making, you will get a number called 451. And that 451 you can see is about 90% of what you would have thought if you had just taken the money on face value. Okay, without discounting. Okay, now here is another option, which is riskier option, right? I take 40%. That means this guy here is a guy who, who's going to put money in a very risky option, because he already has other things which make him 35%, 30%. So he's looking for something which will make 40%. Okay, and you have a business case which looks like a 40% case, in the sense which looks risky and high rewards. Okay, so the guy is excited about it. So he says, okay, your well, the risk is high, so I adjust the risk according to the discount rate is adjusted to risk. Okay, and the numbers look like this. So in the risky case, the 100 rupees is now valued at 71 rupees. So the present value of this 100 rupees is 71, and this 100 rupees, second 100 rupees is 51, and so on, because I am dividing it by 1.4 to the power 1 to the power 2 to the power 3, and so on and so forth. And this is the number that I get out of it. Okay. And this adds up to 204. You can see, first of all, that the same cash flow in a risky situation with a higher discount rate is worth a lot lesser, right? So let's say that you on one side you are Sachin Bansal with a track record of creating money in a startup, and another side you're somebody who has no track record. Your risk will be higher, so your discount rate will be higher. Okay. Whereas somebody who has a track record, the discount rate might be in a sense lower. right? Or if your business has a lot of risk factor, your discount rate increases. So the value accordingly went down. So you can see that depending upon the risk, the discount rate changes, and therefore the value of that money went down. The total present value went down, right? Is that clear to everybody? Yes. Let's hear another round of yes, please. And any no's, please tell me. Okay. Looks like more or less it should be yes. Okay, good. Now let's look at the calculation on the right hand side. Okay, this is a variation. Now, what did I do here? I said that this particular company did not produce the 100 rupees in the first year. Okay, it just was slow in generating money. Instead, it produced it on the 6th year. Okay, that same 500. Sorry, this total is wrong. This should be. Sorry. No, I didn't do it right. You can stare at this Excel sheet a little bit. You'll get it. Why am I not getting this? Okay. So you will notice that by delaying this cash flow and it becoming late by 1 year, what has happened, right? You can see that in the safest case, this number decreased compared to what you could have got if the money had started coming in earlier. So just because it's coming in late, the same 500 rupees coming in 1 year later meant that the present value has declined. Okay, you can see it's 435 compared to 451 and so on, right? So this is the second message here. So delayed money is valued less. Okay, is that also clear to everybody? And is the concept of present value that I'm calculating using a discount rate, I hope is also clear, right? So I've illustrated here discount rate, cash flow discounting, present value, the fact that risk adjusted discount rates, the numbers change, the value decreases if the risk is higher, and if the money is delayed, the value is less. Okay, okay, great. So now let's go to the next part of it, right? So here I'm going to take, we are at 5:37, so let me try and do it as quickly as possible. Here is a sheet where I'm going to give you a few scenarios and I'm going to illustrate to you how things would work out, okay, in different types of investments. So let me explain what this is. I have a few numbers here first. It's the base discount rate, which is 3.55. Okay, percent, which is what the government bond pays. Okay, the FD first year for a simple FD right now, maybe you'll get about 1 year 5%. By the way, this one was done in June last year, so forgive me if the numbers are a little off, but it's okay. Nifty, which is a national stock exchange index, okay, for a 5-year would return about 22%. That was the by the way, this is what happened in the past. It may not do the same in the future, but nonetheless, this is a number to keep in mind. Okay, so you can see that these are the options available to a typical investor. So if you're an investor, you're having money. If you want it very, very safe, you'll go and put it in the government bond. If you want to take a little bit more risk, you'll put it in, say, 5.1% in SBI. If you want to take a little more risk, you will go to a cooperative bank and put it at, to say, maybe 8%. Okay, if you want to take a lot more risk, you will go and put it in Nifty, in the stock market with a Nifty linked index fund maybe, and get about 22%. Okay, depending upon your risk, your ability to take risk and accept risk. Right now, let's look at what happens in as far as cash flow discounting is concerned. Okay, so here I've taken the Government of India bond first. Okay, so you go and you have 1 lakh to invest, so you're putting 1 lakh in 0 time. That means this is 1 lakh rupees you're investing at 0 time, and let's see what comes out of it, right? So you expect 3.55% interest rate. So you will get 3.55, 3.55, 3.55, 3.55, and year 5 you get back the principal and the interest. Okay, so that's what I put here as 1 lakh 3,550 rupees, right? So this is the cash flow stream that you're seeing there, right? By the way, I put the investment as minus because it's money in, and that's money coming back to you after you've invested, right? Now, if I do my calculations, by the way, IRR is a function in Excel. IRR, this you can see listed over there. You will see that you can calculate what this represents as an interest rate, and it's putting out a number 3.55, which we actually was the number that we used as an interest rate, right? You can see that the net present value here is 0 because the discount rate I'm using here is the same as the interest rate. This is the base, absolute safest option available to most Indians. By the way, you could have safer, by the way, if you go to another country, but right now let me take this as the base number. Okay. So this is so there's no value that you're creating beyond the safest bond that you could have put your money in this case, right? And you can see that if I just take the money as such and see how much money I made in absolute terms without the discounting, it is about 17,000 odd rupees over 5 years. Okay, that is what I earned in absolute terms out here on the 1 lakh that I put in. Okay, now let's look at a FD. If it's an FD of 1 year, what you will see is you remember I had told you that this is about 5%, right? Look at what happens in the case of an FD. You can see IRR is 5.1. By the way, the numbers have changed. You can see that number out here as, by the way, are people able to see the numbers clearly? Neha, are you able to see it, or do I need to make it a little bigger? Sorry, I can't hear you.
Good if you can zoom in a bit.
Yeah. Okay.
But it's readable. Yeah, no problem.
Yeah, no, I'm just struggling with this bar. Okay, how's this?
Yeah. Yeah.
Okay, so you can see here that in the FD's case, the numbers went up, and therefore you can see that the net present value is now positive above 0 because the base number was 3.55. You're doing better than that. The cumulative gains is higher than this, whatever you got before, because your FD is getting you a little more returns on the money that you're spending, right? That you're investing out here. Same thing if I went to Nifty, that is National Stock Exchange's index linked fund, the number was 22%. So then you can see the number that you're earning every year is much higher, and you exit, say, from the stock market after year 5, you'll get hopefully you'll get more, right? Imagine an index fund of that kind, which is getting you the principal and some money back. By the all this is idealized, huh? Things keep changing with time, but for purpose of learning, I'm idealizing it. Okay. You will see that the IRR corresponds to the same number that I had put down as interest rate. So IRR essentially is telling you what money you're making, right? And NPV is much higher. The present value, net present value, is much higher than what you saw there. And you can see that just the absolute numbers are also significantly higher that you're making. So if you were wanting to take more risk, you're aiming for this, right? So you're looking for ways by which you get a higher NPV and a higher IRR in the investments that you are making. Now let's take a little bit. So what we will do now is we will just account for a little bit of uncertainty here. Okay. So we say, oh, stock market, you can't say that whatever you earned last 5 years, you're going to earn this next 5 years. Nobody expected COVID to come, right? And COVID could have caused a drop as well. So if it is so, then how do you account for risk? So here, to account for risk, I'm just going to say that the risk adjusted discount rate is 20% and not 3.55%. Okay. For the moment, please just assume that, and you will immediately see that the NPV has dropped here, right? It was 86,000. the NPV, the present value dropped because there's a greater perception of risk. You don't know whether you're really going to make it, right? You think that this should be the number that comes out. Okay, that real value, I mean the value without adjusting will remain at what you expected will happened in the last 5 years. But if there is a risk, the uncertainty is this much, and therefore your number can come down to this much. Okay, but you can see that if this 20% is right, this is not bad compared to the FD 69, which was fetching you about 6,988. A little better than that, 1,000 rupees more than that. So maybe if you trust your 20% number, you will go with this, right? So am I still, everybody is clear still? Okay, so this is part one of the story, right? So right now I've tried to explain to you how different investments, when you as an investor go and put money in, you will find that the perception of risk and the perception of returns will decide, what you perceive as the value of the money that you will make out of that particular activity. Okay. Another simple thing which I just want to point out is that this person had 1 lakh to put, so he had these options. There might be certain options which are open to you only if you have 5 lakhs, only if you have 20 lakhs, only if you have 1 crore. So the ticket size matters, okay, of the investment itself, right? So there are, by the way, investments where they will allow you to enter only if you're putting in a minimum of 1 crore. Okay. So that is that also defines. So yes, when we last meeting, when we talked about different investors investing at different ticket sizes, it has a connection to this here, that you have to find the right ticket size and the right perception of risk that you're operating with, and what you want to convey as the reward and the risk in any given situation. Okay, now let's move to, I'll take an odd case out. Let's think of an inventor like maybe our colleague here from CSMCRI, right? So Shubhodeep is here. So what is that person doing as an inventor, right? What they're doing is that the inventor is sinking in, say, 1 lakh to make a product. Okay. Now, after they have made the 1 lakh, they are hoping that somebody will buy that invention for, say, or come for a license. So they think that they will get an upfront fee of 1 lakh maybe, and some royalty on sales, right? So you have assumed some kind of a sales happening over a period of time, and therefore some royalty on it, which is at about 5% of this sales out here. So first lesson out here that you will notice is that tech transfer, this money stream is inverted compared to this, right? You're getting money at the end here. You're seeing that the money is coming, the expectation upfront here has inverted the money flow. That means that the person who's paying you taking the risk here and not necessarily waiting to deliver at the end. Okay. So there is a inversion that happens, which is something which you have to think about. Okay. Now this sales number decides this flow, and therefore the ability of the licensee to do sales makes a big difference to how much you make out of that investment that you did of 1 lakh upfront, isn't it? And it all depends upon your understanding of risk, which decides your perception of value. So if somebody sees this money stream being 10-fold higher, they will see a larger NPV and therefore be willing to pay more. If they see a much smaller stream out here, they are likely to think of it as a lower NPV and therefore pay a lot lesser for your invention. And in companies which are building technologies to license, this is something that they may need to keep in mind as well. So this is another scenario. Now let's look at a startup. Okay, so in the startup case, I'm going to try and illustrate to you what happens in different situations. Okay, so here is a case one. Here is a startup where the investor has come in with 1 lakh. Okay, and year 5 there is an exit for the investor. Okay. And by the way, when I show all this, you will also notice one more thing, that this particular investor is not concerned whether you are doing a biopharma drug or you are doing or you're cooking dosas and selling, right? They don't care. It is just about money at the end of the day. Okay. They might get a perception of whether the business you are in will deliver those returns or not from what you're doing, but you know, the bottom line is that they are looking at it as money streams. So you as a startup should also be aware of it. Okay, so let's look at this. So this case, 10 lakhs came out as an exit. They got 10 lakhs after they invested 1 lakh in 5 years time. What does this translate to? The calculation shows IRR is about 58%, NPV is about 85,900, 90,000 or so. So for around 1 lakh, the present value is they've got an additional 90,000 value added if they get it after 10 years, although it looks like they're getting 10 lakhs. On the face value, it looks like a cumulative gain of 9 lakhs, okay, over 5 years. So, but you know, it corresponds to an NPV of this much. Why? Because there is a risk. They don't know whether this will go out, right? This exit depends on somebody has to be there to buy. It has to be sold at this price. So there's a lot of uncertainty, and you know, you don't know whether it will happen. So the discount rate here is much higher. Maybe about 40% is what this person has put, because you had put 20% for the stock market. This has to be much higher since it's a startup. So 40% discount rate, this 10 lakhs crashes, the number crashes into about 85,934. Okay. So you can see that this risk is making a huge difference. This 40% number is making a huge difference to how much that is, right? Let's take a slight variation. Here, the company has given an exit in 3 years, right? But it gave 5 lakhs, not 10 lakhs. Okay. And you consider the same kind of discount rate, and what do you get? The NPV is roughly comparable, okay, to the previous case. Although this was 10 lakhs and this is 5 lakhs, just because you gave it back early, the value perceived by the investor is much higher, right? Now, the same thing with 10 lakhs at 3 years, right? If I take 10 lakhs at 3 years, the number is now shot up. You can see it's about 2,64,000, right? The cumulative gains between this case here and this case here on actuals is the same, but look at the value, right, that they see here. So you paying back early or showing an exit which is earlier is a great sign for investors, right? They will see a lot more value in you if you are going to give them an exit earlier and show that there is a way to exit. If there's no way to exit and they don't see investors, larger investors who can give them an exit or a person to buy them out, then they will increase the discount rate. So this will become 50% and then your numbers will crash again. So you have to decide between this. So let's take a couple of questions out here. What would an investor choose between case 5 and case 6? Yeah. So yeah, so let's look at case 5 and 6, right? It's a good question, Harshesh. The question is, what are the options they have, or what are the perception of options they have for the cash they get back at this point here? Because you should remember that they still have this time period to invest, right? That is the next 2 years. So if they have options available, although the numbers look roughly comparable, if they have ways to make more out of this 5, then they may not they would be happy with this one where they make 5 lakhs rather than 10 lakhs. Okay. So remember, see, when a company gives dividends, when a company, any listed company announces dividends, they have 2 choices. One is to keep the money and put it back in the company. Second is to give the money out as dividends. Okay. If the company puts back money in the company, then the shareholders are agreeing that that company will make more money out of the money they are putting in back into the company than other options available to them in the stock market, right? But if they give it out as dividends, it means that the perception is shareholders think they can make more money elsewhere. Okay, they would want to invest it in some other thing, right? So keep that in mind. I mean, so I would suspect that if they have other options to invest, they would go with this and not necessarily this one, right? Okay, well, will the investors, yeah, who decides the discount rate? Yeah, this is all perception, right? So discount rate is so how well you present your story will decide the implicit discount rate. By the way, even if the investor is not doing a discount rate calculation explicitly, there's an implicit sense of risk. Okay, so if your storyline is weak, if there is flags which are raised of risk, your discount rate immediately goes up. Okay, so keep that in mind. Will the investors do their own calculations? Are they expecting the startups to present the case? Okay, so the startups are expected to very often provide some financials, right? And some investors will even give their own format in which you have to present the financials. Okay. You can always put your numbers in and provide whatever. We don't do calculations of valuation and so on, that we normally avoid, but we'll give the numbers and they can do the calculations, right? That said, most investors would take that with a pinch of salt. Whatever numbers you give, they will obviously, as they say in general rule, you half all the incomes, you double the cost, increase the timeline, and then you read the Excel sheets. That's what. But the more important thing is it tells the investor what's the mechanics of your company, and for that reason the financials are very important. Okay. Okay. What if startup assumptions, promise, and expected cash flow are not realistic? Yes. So where does that affect you? What happens is you will just change the discount rate. That's all. Right? There will, realistic or not is only a matter of how uncertain your story is. Okay. Does the investors VC fund declare their target IRRs? They don't, but you can figure out some of those things. Okay, they roughly, for example, what they're targeting as a portfolio. You don't know, for example, what they're targeting in each investment that they make. Okay, so that is something which you have to keep in mind. Okay. Okay, so now let's move further. This is the startup story, right? We did 3 cases where we saw how money returning back at different times is perceived differently by the investors, right? So here is another case where I'm taking the entry at year 2, okay, instead of year 0, right? So I've done the entry. I'm entering the company with an investment in year 2, right? How does my number look? You do realize that with time, first of all, your duration of investment is shorter and you have reduced some risks, hopefully. So the fact that you have reduced risk in the first 2 years, the discount rate, I have brought it down to 30% from 40%. Okay. And therefore the value is quite attractive. It's showing up quite attractive even for, with these numbers out here. In another situation, what is happening is the investor decides he'll put in more money, right? And get a little, get the same out, the same discount rate, right? You are seeing that because the multiple is smaller, you'll again see that the NPV has gone down and the IRR has gone down. Okay. And irrespective of, just as an example to illustrate that. So I hope this sends of some few clear messages, right? So if you're coming late, you may need to invest more is a lesson. For the same return or comparable return, like here in this case, it's 1 lakh, he got this much, but because he's coming late, they may need to invest more and therefore the returns come down. So there is an incentive to come early if they're willing to take risks. Okay. Okay. So now let's look at a couple more cases. Okay, here is a case. I'm just repeating case 5, by the way, first, where the startup with an exit at year 5 at 10 lakhs. Okay, now let's look at an impact investor. Okay, and how the impact investor is thinking, right? So an impact investor is again putting in money, 1 lakh, similar, is okay with 5 lakhs coming at year 5. Okay. But they want to know how much livelihood are you creating out of your business. And let's say, just as a rough number out here, I have said that you're creating 1 lakh worth of livelihood returns every year. Okay. So by the way, the total value creation is about 10 lakhs compared to this, similar to this, right? But here, this is livelihood not coming into your books. You just created those many jobs, and those jobs are impact that the investor is seeking, right? So what do the numbers look like? So if I had just gone with the cash returns for the investor, you can see that the NPV here is low, negative. In fact, IRR is 37.97. And but if I take total value creation, including the livelihood, my number is phenomenal, right? I'm looking at 110% and NPV of almost 2 lakhs out here. So a typical impact investor is willing to forego a little bit of this, but not entirely. And at the same time wants to see this impact, right? Now, besides the fact that they're getting returns out in some measure, there's one more interesting thing, which is that this livelihood thing, although they have exited, continues over years, right? And that is also additional value for them because they have exited the deal, they have done their job, but the good work that they have done continues, and that's additional value that they see created out of their involvement as an impact investor. Okay, any questions at this point? This is something which I thought was very interesting. I hope people understand how impact investors are thinking. Everybody understands it? Quick questions. Yeah, so the exit question, I think there is no difference as far as these financials are concerned. Okay, the question what happens after that will be what matters. The returns for an investor might be very comparable, whether it's an acquisition or a bigger investor comes and gives them an exit. Okay. So is everybody with me, or is somebody lost? Anybody who is lost? Don't hesitate. Okay, learning is more important. Okay. Okay, here I'm coming to another important part, okay, which is a case of the government for supporting. Okay, so when the government puts in money, let's say they give you 1 lakh, they get nothing out. There's no cash here. You see this? All is zero. Why are they giving you a grant? Well, they give you a grant because hopefully through taxation, direct or indirect, there's some money coming in, right? So let's say here I put about 30,000 just as an example. And then you have also created some livelihood. That means you created jobs, right? So there was a livelihood contribution and there was a tax contribution. And because of that, the total value creation is about 1.3 lakhs, right? So when a good government who same gives you a grant and doesn't expect anything in return, they are eyeing this. Okay, so it's your ability to convince the government that you're indeed going to develop and indeed going to deliver this. If you're a company which looks like somebody who's not going to deliver either of this, your chances of raising money from government is very low. So here again, you can see the NPV and IRRs. You can see that's quite attractive for the government if you look at the total value creation from this activity. Okay, that they are getting a lot by giving you a grant. Okay, so think of it that way. See what, and please remember that this is just for the 5 years I calculated, right? Of course, I've put some numbers I've cooked up, but please remember that this will keep going on for them, right? That means if you continue as a company, you'll continue paying taxes as long as you're alive as a company, and you're going to create jobs. So they have done their job as the government. Okay, and they should be thrilled about it in terms of creating all this goodness out of supporting you via a grant. Okay, so now I have justified why each of you deserves a grant. Okay, so please keep that in mind as well when you present for BIG and all that. What are you going to deliver at the end of it, and convince people that indeed you're delivering. Okay, okay, the last segment which I have here is that there's a POC grant plus an investor coming in. Actually, wait, I think I don't have time for this, so I will quit this, and we will go on to the rest of the story. Okay, so I hope everybody is BIG is not seeking equity, by the way. It's a grant even now. It's just that it is seeking royalties, but on capped royalties. That means it's capped at the amount they gave you, but it's still a grant. It is not a loan. Okay, that means if you fail by any chance, it's not that you have to pay it back. Okay, so they're still giving you a chance to take that risk. So it's still very good in my opinion. It's just that it could have been sweeter if there was no royalties. Okay, so now we have looked at it from the investor's lens and seen what determines value here. So I think hopefully all of you have learned that. Yes, by the way, that's true. Government is a for-profit organization. Yes, in fact, everybody is for profit, because profits is what drives taxes, right? And taxes is fueled back into all the activity that you're doing. So it's a good thing to have profits, and you're doing a good thing by generating profits. Okay, now let's talk about a new startup and its financial evolution. So we're at 6, so let's continue quickly. So the financial simulation that I'm going to show you is meant primarily for strategy purposes. Okay, just to understand the mechanics of your business, to get your business model right. Accuracy of the numbers is not important. It's a broad stroke. Make assumptions, but keep minimum assumptions. Okay, don't try to pack your thing with lots of assumptions, because then you will not be able to do any parametric analysis. Okay, so it's what I'm trying to show you is a broad sketch. It's like an impressionist painting. Okay, not meant to be an exact painting, okay, of a realistic painting of Mona Lisa, but more of an impressionist look. Okay, Van Gogh maybe. Okay, now and then we'll use it for a little bit of, we'll also talk a little bit about financial planning and budgeting. One thing I find it very useful this does is, most of us scientists and engineers tend to think of technology only. We don't think of products and services and how it's going to make money. And that is something this really forces. Okay, the simulation forces you to think in that line. The second thing it does is that you will realize very, very quickly that your market research has to be directed towards making sure that your assumptions are right. Okay, you don't need to scan the whole world to get your market research right. You just need to get your market research right enough to get the assumptions right in your simulations, right? So that helps you focus your market research on the most important things and not everything. Another important situation we see is many startups having 2-3 ideas they are pursuing, and they want to know which one to pursue. Okay, which is a better bet, right? How do you decide that, right? One way is, if you're raising money, you want to see which one creates more value for your investors, right? A very simple way of looking at it. If you have 2 revenue streams, which one is creating more value? Which one will drive your valuations? And go with that in the very beginning, right? If you want to get to market fast, get revenues very, very quickly and not worry too much about valuations, then you might look at what gets to market faster. But don't assume that what gets to market faster is going to increase your valuation more. Okay, that's a very big mistake to make. Okay, so very naive way of looking at it. Many people tell you, get to market fast, get to market fast. Yeah, please remember that that doesn't mean that your company is creating more value. Okay, so it's quite critical to understand that, and that you can do by your financial simulations and see which one is adding more value to your company. And that's the reason I've been talking about value and cash flow discounting, because I'm going to come to that and show how it's getting created in your Excel sheet. Right? Okay, and you will need some important data points for your investment pitch. You will need, for example, somebody might ask you, what is your COGS? What is your BOM? Okay, what is going to be your sales 5 years from now? Right? What is the IRR that you're looking at? Okay, these kind of numbers. How are you going to pull that out? What is the proportion of your fixed cost to your variable cost? Okay, how much are you spending to make a given sale? What is your cost of sales, right? So all of these things you will not be able to do if you don't do at least a reasonable financial simulation. So don't shy away from it. It's very simple, nothing to be worried about, but you need to do that. You can also do a lot of different analysis. The slide will be with you, so I'm not going to spend time on this. So now we will go to the simulation, but before that, a story that I'll tell you. Do all of you have this sheet with you now? If so, if you want to go back and forth to it, please keep it open, okay, on another tab, because I will be going in sequence. If you want to go back to look at an equation, you may need to keep it open. So I'll give you a minute. Everybody can please keep it open on another tab. Okay, this sheet, exercise simulation without answer. Anybody struggling with it, needs help, please, Mugda or Neha can please help. Okay, and the back end, please communicate and help them open it up. Okay, okay, now we'll start a story. Okay, this is the story that I'm going to use to generate the simulation. Okay, so here is a story which we use in our city camps. So some of you who have attended might be familiar with it, but I'll try and add a few more things to it. Okay, so here the two friends, okay, Ashish and Boni, want to start a company. Right, they're very keen on starting a company. They believe that that's the future for them. That's where they will realize their full potential. They're not too keen on the kind of things that they are doing right now, and they keep discussing ideas, you know, whenever they meet, of what they could be starting up a business on. One day Ashish smells an opportunity, right? He spots one, and in his work he notices that you know, that industry has a pressing demand for an instrument X, but the company that he's working for is not interested in this X. They don't consider it a core product for their company, and that X sells at around rupees 1,500, and there's a demand of at least 1 million instruments in Asia alone. There's a customer C he knows, who is willing to place a pre-order. Okay, the guy says, I'm willing to give you a pre-order for, you know, so many pieces if somebody can deliver this, only deliver this. And Ashish's company is not interested in doing it. They consider it a small opportunity, but he thinks this is the opportunity for his business. So he takes some time, chats with Boni, discusses with Boni. Boni is a technical wizard. Boni does all the research on this instrument X. He goes, digs it up, finds out how it works, what are the components needed, what are the technologies within their reach, what he can do. He tries out some things also, figures out all the details. And he finds that there's one key thing which he needs out of this, which there are different research groups around the world who are working on it. Okay, and Boni identifies a university group in Greece that has the technology for making X. And Greece is in a financial crisis. You know, they are very keen to work with entrepreneurs who are willing to take their technology ahead. So over phone calls, they learn that this Greek group is willing to sell them that exclusive technology license. And the Greeks, by the way, do not know what they have their own use for the technology, but they don't know what you know, Ashish has in mind as the application for this particular technology. Okay, piece of hardware, how it is used, that is not something which they have really thought through. right? So this is a piece of hardware, and the software and the algorithms is something which Boni is working on. He's developed it. He just needs that piece of hardware to go with it, and that particular application with some modifications. And the Greeks have not yet figured out that particular application. They've not smelled that opportunity yet. Okay, so they're thrilled at it. They're very excited by this opportunity, and they realize that this is going to take a lot of other effort and time, so they just cannot do it part-time. So both of them decide that, look, we have to do this full time to put the pieces of puzzle together. There isn't much time, we have to do it fast. So they resign from their jobs to pursue their startup idea full time. Okay, they sign a co-founders agreement between the two of them, and they register a company called Rama Products Private Limited. So the company's name is Rama Products Private Limited. They have a co-founders agreement because they know that they don't want to wreck their friendship because of business disagreements. So they do a decent co-founders agreement detailing out what will happen if there's a fallout of some kind, or the company closes, or whatever it is. Okay. The next thing they do is both of them fly to Greece to negotiate a technology license, right? The Greek university is very keen to sell the technology. Their economy is in bad shape. The university needs the money. They negotiate a license with a one-time fee of rupees 30 lakhs. Say, we'll give you 30 lakhs, right? We don't have the money right now, but within a month, we'll give you 30 lakhs. Okay. So Ashish and Boni request time of about 1 month to come back with the money and close the deal. They ensure that they will not lose out on the deal. They sign a tentative agreement, an option agreement saying 1 month to close the deal, or 2 months to close the deal. And in 1 month, we'll come and close the deal. Okay. Terms are roughly agreed already. And it's a 30 lakhs one-time fee. Okay. That's what they're going to decide. Now, Boni then dials a friend who spent 7 years in Shenzhen. Okay. And he has some networks, good networks. He leverages them, technical networks. He asks for leads for Chinese companies with core technical and manufacturing strength for this kind of product that they want to make. And then once they've identified a few, they fly to China. They meet 10 potential manufacturing partners. They finally zero in on one partner, Y, who is willing to manufacture the instrument at 225 rupees. Okay, that's 15% of the 1,500. So he's actually so keen that he says, look, you take, I think, you guys are great guys. You'll be able to sell it. I'll give you 400 pieces on credit. Okay, you at 225 rupees, you go sell it and just pay me back. And only thing is, make sure that when you make more, you come back to me. Okay, I want a continuing arrangement of manufacturing with you, and that you should not go to any other party, but I'm willing to give you this credit. And Ashish is a great negotiator. So they sign a agreement with the Chinese party to share the hardware designs. They sign an agreement with the Chinese party to seal the agreement arrangement and promise to place a firm order within 45 days. That means they say 45 days, give us, we'll come with a firm order. Okay. Yeah. Now, this piece, as I told you, has a hardware component and a proprietary algorithm software code that makes the hardware work. And the hardware will be useless without that proprietary software for this application. Okay. So they have retained some of that part. They're willing to work with that party to get the hardware, but they're not revealing anything about the software. Okay. Yeah. So let's go ahead. Now, following this, you have to have more networks, partners that they see they're going to need. So there's two friends fly back to India, and Ashish now gets into action. He is an industry guy, right? So he has an industry network. They identify a potential distributor D based in Mumbai who has his own warehouse. Okay, and this distributor agrees to stock the inventory and distribute the instrument for a success fee of 25%. So he has a warehouse. He says the Chinese guy can ship it here. I will go and sell it. And whatever I get back, I want a 25% success fee. That's 375 per unit of sales. Okay. And I will not charge you for stocking. I will not, I'll take care of all the logistics of distribution and sales. Right. And of course, you can see that these guys are great negotiators. The deals that they are striking are quite good. Okay. Now they have done all of this homework, right? First of all, they have taken the leap. they have started a business, right? They've taken the leap to go ahead with this. They have smelt an opportunity which they think is worth their while. They're willing to put in all their effort and time into it, right? They have done their research to figure out which are the technology components needed, what they need to put together, who has it, and where to get the parts. They've gone and figured out a technology licensor to license the technology. They've gone and figured out a manufacturing partner. They've gone and figured out a distribution partner. So you can see that these guys are really entrepreneurial, right? They are go-getters, and all this without having any cash to pay for it, right? And they have tied up saying, we'll do it, trust us. Okay, so there's a lot of, you know, great negotiation and great faith in what they are doing and the commitment to what they are doing. Right now they need an investor, right? They need the money. So they need to figure out how much money they need. Of course, you know, you immediately would think, they definitely need the 30 lakhs, but probably they need more. We'll try and figure that out. Okay. And with the technology and manufacturing partner, distributor, everything figured out now, they're brimming with confidence. They're looking for an investor, but they have no experience in getting this investor, right? How do you go to an investor? How do you raise money? They have no clue. So they go around looking for a mentor. Okay. While these guys are very confident, they are also humble in acknowledging the areas where they are weak. By the way, I have a hidden message there for you guys, which is that it's important to be humble. If you're an entrepreneur, learn to learn from others. Okay, they're good listeners and learners, and they are mentorable. By the way, most mentors have this as a feature in their list. If they don't think somebody is mentorable, they don't bother to waste their time. Okay. So this is a key criteria, right? They visit the venture center looking for some advice and linkages, and they meet my colleague Shoma and give her a brief introduction to the business idea, right? And this business idea doesn't have all the details, doesn't have the full business plan, because they only need to work on the essentials. So they talk about this, which is I've written here as a business sketch. They say, here are my offerings. This is what we're going to offer as a company, which is X, product X. It's meant for whom? I'll explain that to you. They say who will pay for it, right? That they're identifying the customer who's going to pay for it. They say, here is a value proposition. This is the reason that they will buy from us. They say what value it's going to create and compared to what is available in the marketplace. So you all studied about value proposition, that in a brief they mentioned to Shoma. And then they talk about revenue models, right? How will it make money, right? And key risks and uncertainty. What is the price point that they're going to sell it at, right? Now, this is enough information for somebody like Shoma to take a view on whether she can help, whether it's worth helping, whether it is something interesting, and so on. Okay. And that Shoma decides that, oh, these guys are really committed. They know they're taking risks. They are really entrepreneurial, very resourceful, and they've explained their business so clearly to me. You know, I think we should support them. Okay. So Shoma assesses the business idea, finds it interesting. They're highly motivated, resourceful, and decides to support, right? So she says, okay, guys, you need to prepare a pitch deck. Okay. And that pitch deck is something which you will need. You will also need an elevator pitch, and you will need to send to potential investors, for which you'll have to draw up a list, right? And they start doing their homework. So here on the right, you see their elevator pitch, okay, that they're going to make. So Mugdha, on my screen, you're not seeing any black boxes, right? Can somebody tell me if you're seeing any black boxes on my screen?
No
Not
black
at all.
box.
Not a screen.
Oh, okay, good. Okay, so let's start. So this is the elevator pitch. We are Ashish and Boni, co-founders of Rama Products, which is a Pune-based technology startup that manufactures and sells Instrument X that helps transportation vehicles reduce their fuel consumption by 30% by using novel patent-protected sensors and data analytics and AI algorithms. That patent-protected things is from Greeks. The product can be easily retrofitted to existing vehicles by fleet owners to increase their savings So they're looking at Ola, Ubers, and then and enhance their margins while also reducing carbon emissions. Rama Products is addressing a $30 billion global market opportunity in the mobility space. Rama has exclusive worldwide rights to patent protected technology. Rama Products is led by a team of 2 engineers with the COEP, College of Engineering background, and University of Michigan backgrounds, both known for automotive engineering, and 20 years work experience in leading commercial vehicle manufacturers, Mercedes-Benz. We are seeking an opportunity to present our business plan to you and interest you in participating in our company as an investor. We are seeking rupees 50 lakhs in equity investment for a minority stake in our company. We think we can provide an exit to the investor within 5 years at a 10x multiple. Okay, this is what they go and pitch. Okay, now here they have brought in some numbers, right? 50 lakhs. Where did they get the number from? How did they arrive at 10x multiples and so on? That is something you will get from your simulations also if you need to do that. So, so 2 minutes. So you, but I'm not in the competition right now. Anyway, let's go ahead. So the search, they begin their search for investors now. Okay, at this stage. So they prepare the storyline, which by the way, I've asked all of you to do as well. They draw up a list of 50 investors and reach out to them through various means, right? The top things, they use their referrals from mentors and incubators. They use networking events. They visit a few networking events quickly, which Shoma points them to. They go to some business plan competitions and with some direct communication. After they line up 50 and write to them, 2 of them show interest. Okay, 2 investors show interest to learn more and consider investing in the company. One of them, Isaac, happens to be a fellow COEP alumnus, okay, who agrees to invest in the company. For him, he sees a younger version of himself in the 2 founders, and he offers them a term sheet, which Ashish and Boni readily sign. Okay, so he says, "I'm willing to invest." Okay, and Isaac gets his technical, financial, legal teams to do a due diligence. So the investor is basically doing a due diligence on the founders. He finds out their background. Are they ethical guys? Are they responsible guys? Have they screwed up somewhere, been in jail, all of that? And also find out if the technology has any merit and if the business idea has any merit. Okay, and he decides that yes, this has merit and he's going to go ahead with it, right? Following the due diligence, they sign an investment agreement and Ashish and Boni receive 50 lakhs as equity investment from Isaac for a 14% share in the company. That's what they agree to. Okay. And with that money in hand, they can now go full steam ahead. Okay, with this money, close the deal with the Greek group. So they go to Greece, close the Greeks parties, get the license, exclusive license, place orders with the Chinese party, right? He's willing to give you with, on credit. Great. The Chinese party is shipping it to you to the distributor D. The distributor D also finalize the agreements. The fellow finds the customer, sells it. He firms up, and you also know C, customer C, who is willing to give you a pre-order. You sign up the pre-order and the distributor is excited. Oh, you already have a pre-order from customer C, great, let's get into business, and everything starts rolling, right? So that's where, so we're going to do the simulation. So just summary numbers. So we said the price of the instrument was 1,500 per unit. We said technology to make the hardware came at about one-time cost of rupees 30 lakhs. Contract manufacturer Y was willing to supply at 0.15, 15% of the eventual price, but he will state it as 225 rupees. And the distributor D is willing to sell X to a customer at at 25% success fee. And they realize that the distributor is willing to stock it, the manufacturer is making it, and distributor is going to sell it also. Why do they need a big office? Why do they need a asset over there? They just need one manager to help them, and they hire a manager at rupees 6 lakhs a year to run this business, and that's only overhead that they are going to incur. So now this dream business is what we will simulate. Okay, so I'm going to stop share and go to the Excel sheet now. Okay. Okay, can you see the Excel sheet?
Yeah.
Okay. So all of you, I hope, also have opened this up. Now we are going to go through this very, very quickly and see what we can learn out of this. Okay, so here is the scenario I told you: A and B founders, investor I, technology provider G, contract manufacturer Y, distributor D. The selling price is 1,500. Technology purchase was at 30 lakhs. These are all assumptions. By the way, whatever is marked in red are assumptions. Maybe I need to blow this up, right? Is it clearer now?
Yeah, this is better.
Okay. So all these numbers are the tunable numbers. These are assumptions I'm making. Okay. I'm assuming that I can sell it at 1,500. I'm assuming that everything, some things are known, like I have already thought that I can get this. So this is happening before they went and raised money. So they have not tied up everything. This is all assumptions at this time. They're going to tie up as many things as possible. And manager is at 6 lakhs and so on, and contract manufacturer 15%, distributor 25%. Okay. I've put a few more assumptions. I'm increasing the price at about 5% a year. This is just an assumption. The sales volume in the first year, I'm able to sell 400 pieces. Okay. And this 400 pieces is what you remember this guy has agreed to give us on credit, the Chinese manufacturer. And growth rate is about 40% is what I've assumed. Okay. And we have all these numbers. Now with this, we start simulating, right? So here you see year as a row, you have income and you have expenditure and some profit, some taxes, net profits, and I'm taking the cumulative profit or loss in one row out there. Okay, so this is what we'll first see. So instrument sales, right? You remember it's 1,500 times 400, which is 6 lakhs, and then depending on the growth rate of the business and the price increase and so on, it keeps increasing over a period of time, right? So in year 5, you have about 28 lakhs in sale in this business. May not be great first sight, but it's okay. Let's look at the numbers and see it meets their aspirations as an entrepreneur, right? Expenditure, right? One-time expenses. What is the one-time expense on the chat box? Quick answers, anybody? What is the one-time expense here? Licensing fee, okay, from Greece. So that was the 30 lakhs. Right. What is the fixed recurring overheads here? Fixed, yes, salary, manager salary, 6 lakhs, right? What is the variable recurring out here? What was the variable recurring costs out here? So it's 15% manufacturing and 25% distribution, right? So it's 40%. 40% of 6 lakhs, which is 2.4 lakhs, right? So that was your variable recurring. And now you can add up, that's your total expenditure, minus it from the income, and you have your profit. And you can see first year you have a loss of 32 lakhs, 40,000, right? That is your loss that you're going to have in the first year. Obviously, somewhere the money has to come. That money is going to come from the investors. Okay. Now, let's say it continues to the next year, and you find that although you don't have to invest this 30 lakhs, you're still at loss in the second year at about 1 lakh or so. So your cumulative loss goes up to 33 lakhs 58,000. Okay, that's the lowest we are going actually in this simulation in terms of the cumulative loss. Next year, you find you're profitable. So the first 2 years, you're in loss. Next year, you have started becoming profitable. You can see the profits are positive. Okay, that means the income exceeds the expenditure, and that has begun. And the cumulative profits, or in this case, loss, is decreasing, right? From 33.58 lakhs, it is decreasing to 32.80 lakhs because you started making some profits. So you can see it progress. So you can see income progress, sales progressing, expenditure progressing, profits changing to positive here in year 3, and cumulative profits keeps negative until year 7 here, where it turns positive after he has earned enough profits to make up for the cost, okay, or the losses that he made in the first year. right? So this is what the picture looks like. And you can see that I've just also put down operating profit per sales. You can see that after the initial up down that happens because your numbers are too small, it's sort of settling in at about 50% as your operating profit to sales. Okay, in this business, he's making at least 50% or so as profit, okay, on his sales. And right now, this is all assuming that everything stays the same, right? What if your manufacturer said that he's going to charge you 25%, not 15%? Your numbers will change. What if your distributor says ki, okay, now that you're selling a lot, I'll be willing to negotiate, and in the negotiations you decide we'll reduce it to 15%, right? So then your numbers improve as well. Okay, so you would see numbers evolving such as this, and now with these numbers you're ready to do some calculations. So here the number that matters to investors is your profits, right? These columns that you're seeing, rows of profits. Okay, now if you take that row and then you calculate say the IRR, and here I have used for many years, by the way. I've done a longish simulation, but yours can be shorter if you think you can get to money faster. You will find that this particular revenue stream out here, this profit stream out here is giving you an IRR of 43%. That means it's roughly like an FD which is giving you 43% if it works out this way. Okay, but of course there's risk, right? And that risk means that your how much it comes out as can be much lower than 43%. But if all pans out, if this really works out, it's 43%. That's what you're saying. And the value, the net present value of this stream of money here is coming out to about 2.43 crores. Okay, and that 2.43 crores is the a value of this profit stream according to this storyline. So it depends on the storyline, and the person, and the investor who is looking at it has decided that this looks very good, credible company, guys are trustworthy, they seem to know what they're doing, they've tied up all the loose ends, and I don't see any reason to believe that it will not work out, so I'll give them a discount rate of 15%. Okay, and therefore they have landed up with this number roughly. Okay, now this number, the one other number I have calculated here is how much is the investment needed. Okay, so by the way, you can do very detailed calculations, but I usually use a very simple method, which is that assuming that you don't have major cash flow problems in your business. So your business, if you're working with the government, please assume you'll have cash flow problems. Okay, so in which case all this doesn't work out. I'm assuming you have a decent customer and you want to keep a buffer with this kind of a loss, which is this number out here, which you're seeing here, 33,558, which is the lowest point in the cumulative profit. If I want to keep a buffer for some up and down inventory, this, that, some cash not coming in on time, whatever it is, maybe I can keep 1.5 times of that amount. Okay, so roughly this 1.5 times is about 50 lakhs. Okay, so I've used a thumb rule just to say that I need to have at least 50 lakhs of money to make this business work. Okay, so the money I need is 50 lakhs from the investor to make this business plan work as it is shown here and simulated here. Okay, so this story was worth 2.43 crores with a promising an IRR of 43%, provided the investor helps you with a 50 lakh investment. Okay, I've just put down a few other numbers just to illustrate that as you go down the road and your risk reduces, if you reduce your discount rate, whatever revenue streams follow after that, the numbers can be high, the valuation will keep increasing. So that's what happens, if the investor is coming in later, the valuation is higher, so the person is putting the money in at much higher valuations because your discount rate has reduced, okay, for the same stream of money. Okay, so I hope this is clear. So we'll take it to the next step, but before that, another round of questions, right? So questions, right? How do we measure how much equity would Ashish Boni give to the investor for 50 lakhs here? Okay, So how much equity is always negotiated, but I'm going to come next to show you how that how it fits into the balance sheet and the share progression chart. That's why the share progression chart is important. Okay, so hang on, hold off for 2 minutes. Okay. Yes. So okay, about the loss, Harish, basically what happened is that one-time expenses of 30 lakhs and other expenses, and the fact that you are not making much income in the first year gave you a loss of 32 lakhs, right? And that loss got worse in the second year with another 1 lakh in loss. So that became 33 lakhs 58 in cumulative loss, right? Progressive loss. That is what the number is that I'm using out here, right? And this loss is just because he has to spend money, right, for buying that license from those Greek guys, and that money he has to account for somehow. So he's going to do that to investor money, but in his books it'll show up as a loss, which he's making up through investors funds. Okay, it's not going to come from anywhere else. It's just a loss here in the books, but later it will be but it's being fueled by investor money. Okay. Okay, I don't know if I answered that question. So let me know, Harish, if that is clear. Okay. Tulsi says, we assume we get 30 lakhs as 0% loan, or we get from the investors. Yeah. So we're going to get it from the investors, the money from the investors. I'm going to show you how that comes in. Okay. And that is my next part of my story, right? Yeah. Okay. So this, see, this 30, yeah. Now, if he got a government grant, what will happen is the government grant might pay for these expenses. So let's say it pays for this expense, first year expense, and the numbers will change, right? So by chance, let's say that he can get a loan, not a loan, a grant for the 30 lakhs, just by chance. Okay. You will see, I can remove this. You can do it on your sheet, by the way. I remove the 30 lakhs. You can see that the numbers are shooting up, right? Valuation has tremendously gone up a lot. Okay, so you can play around with it, try it out. What happens when you get a grant, right? So basically the grant, what it does is it reduces your expenses when you're in the red. That is the job of the grant. Okay. Hopefully you'll get out of the red and get into the positive someday. Okay. Now the valuation part, I just wanted to show you that as you move ahead, right? See, if you come in 1 year late, you'll only look at the revenue streams coming 1 year later, right? Not so your calculation begins from that date. You will not consider the money in the past. Okay, so obviously, if you're getting more and more certain about the numbers, your discount rate reduces, and therefore your valuation goes up. That's how it works. So it's not rocket science. It's very simple. Okay. So just go try it out yourself. You will see those numbers changing. So let me continue. So now I'm going to, by the way, this whole thing, you can graph it and you'll get a graph. The graphs here look like this. In this case, the green is the profit, the income is in blue, the red is in expenditure, and the cumulative profit is in violet out here. What do you see here? By the way, this blip in the first year is because of that 30 lakhs that you're spending on technology license. By the way, if you're capitalizing, it may not show up in the sheet, in which case it'll be looking nice here. But nonetheless, for the moment, this is showing up as a blip, and that results in a loss in the first year. You can see you're getting out of that in third year into the positive range, and that is the break even as far as profitability is concerned. And then you're catching up on the money. That means you're catching up on the losses with your own earnings only in year 7, and that's where it crosses over to the positive, and that's another break even. That's investment break even. Okay. So these 2 points are there. Now this will move depending upon the situation. Okay, so one of the exercises I've given you is to change those numbers and see what happens, and you can see how the graph changes, how the numbers change, which we will do as well in this exercise. Okay, so before that, let's go over to see how things are evolving in the share progression chart, right? So here is the share progression chart for this particular company. I hope you can see it clearly. On the first green boxes indicate the situation in the very beginning when Ashish and Boni created the company. Okay. Now, when they created the company, they decided that they will share the company equally. So it's 50-50. They have decided on a 50% each. And what does that mean? That means in India, when you create a private limited company, the minimum capital that you have to put in is 1 lakh. So which means you have to put in 50,000 each at 10 rupees, right? Sorry, 5,000 shares at 10 rupees each, 50,000 each of them are putting, and therefore they have 50% of the company. So this is how the company will begin, right? Two people owning 50% of the company, which is 5,000 shares each. Okay. Now, when they go to the investor, what they do is they have please remember that between this period and this period, when they are at the investor, they have done so much more. They have left their jobs, they have designed, they have figured out how to get the technology, they have gone and signed technology licenses, they have signed with the contract manufacturer, they've signed with the distributor, they have learned how to do a pitch, they have written to many investors, got investor interest, and all of that. Okay, and all of that means that their company value, by this 50-50 means the value is at 1 lakh. Okay, the value of the company has actually gone up considerably. And in this case, by the way, as I will tell you, it has gone up to 3 crores. Okay, and right now take it on face value. Okay, but the company value has gone up to 3 crores in this case as pre-money valuation. That's before the money comes in, and the investor agrees to put 50 lakhs in the company at a pre-money valuation of 3 crores for a certain share of the company, and that you can calculate will come out to be 14%. So the way it will work is that Ashish and Boni will issue new shares in the company, 1,667 shares at a certain price such that the value comes to 50 lakhs. And that when they do that, this number of 1,667 out of the total shares will make this guy holding 14%. And these two guys will get diluted to 43% from 50%, right? Remember, note that the shares are the same. It's 5,000, 5,000, but it's out of a bigger pool. And the bigger pool, you widen the pie, right? And widen the valuation, increase the valuation of the pie. And that has resulted in 14% with the investor and each of them getting diluted to 43%. Okay. Now, so how did they arrive at this number, right? So 50 lakhs they knew they needed from that Excel sheet, which I showed you, right? So that number they figured out from there. Okay. Now, the only other question is, how did they come to this number, right? Now, this number is negotiated. There's no sacrosanct way to do it. When they went and pitched, the investor, there are situations when the investor already has in mind that, I'm not interested if these guys are going to give me less than 10%. Okay. Or, I'm an early investor. I don't want to have very high percentages. I keep it below 15%. So you would have narrowed down some range, and this is the range that I'm going to play in. So if they need 50 lakhs, and I have thought that, I'll roughly play in this range, and so that my next round, I can get a fairly good exit. Now, this guy would have thought that he's not too concerned about the 14% actually. What he's concerned about more is that this 50 lakhs, say 3 years from now, will it give him the multiples and the IRRs he wants? Okay. Whether it is 14% or 13% or 10%, as long as it delivers that IRR, he will be fine. Okay. That is what a typical financial investor will take into consideration. So they are not too keen on trying to increase that percentage number. They are more interested in ensuring that their returns are attractive. And for that reason, this pre-money valuation number is important to them, because it is as I told you in the last talk, it's the denominator of the multiple. Okay. And that becomes important for you, okay, as a company. So this is the number that they are actually negotiating. They know they need 50 lakhs. So but don't try to, when you're pitching, don't try to go and tell this number upfront or this number upfront to your investor. That is what you're negotiating, 14 or this 3 crores. What you need to tell them is, I need 50 lakhs to do this. Okay, that is the number that you have to arrive at. Okay, and for that you need the Excel sheet to calculate what is the number that you need, and also justify how far it will take you to get there. Okay, now this 3 crores, is negotiated. Yes, it could have been 5 crores, 10 crores, it could have been 1 crore also, depending upon the situation, people willing to show interest, all of those things. If you don't have any choice, you might settle for a lower valuation, whatever. There's nothing sacrosanct about it, but they got an indication of this by looking at this valuation, which is that, I think this story is worth at least 2.5 crores. So let's pitch 3. Okay, so they have pitched 3 as the valuation out here. So the pre-money valuation is what is the sum of these two numbers. Okay, that is, if you take this 3,000 rupees per share price and calculate the value of the 2 old shareholders, that will be pre-money valuation. After you put this money in, the new money that comes in, that becomes post-money valuation. That's all it is. So don't get too caught up in these words. It's no rocket science. It's very, very simple. It's valuation before the money comes in, and money valuation after the money comes in. Okay, so at this point, any questions now? Any way of comparing flexibility on using investor money versus restrictions on using grant? Okay, so see, grant is always sweet money, right? It's somebody else's money that you're getting to spend. So why would you worry about it, right? All these restrictions and all that you live with if you're faced with options, I mean, where you're faced with alternatives, where it costs you money, right? So I wouldn't worry too much about it, right? You will just plan around it. If somebody is giving you a grant, you go with it. Okay, you figure out a way by which you can make things move. Okay, so there's some simple thumb rules, by the way. If you're taking a grant and are worried about flexibilities, the best way to get flexibility is to have a kitty of money which is flexible with you already. So that could be your investor's money. Okay, that basically makes your, so the one big problem with government money is cash flows, right? They don't come on time. They don't, the flexibility is not there in heads. So to make that move, to grease that whole problem, investor money works quite well, or your own money that you put into the company. Okay, so that is a good way to deal with it. So don't worry too much about restrictions. It is not most startups would love to get some grant and go ahead with it. Okay. Okay, now how did we arrive at the 3,000 rupee price? Yes, so 3,000 rupee price, as you will see here, is basically a reverse calculation. Okay. So first you'll arrive at the fact that it's a 50 lakh money that you need, right? You will arrive at either this pre-money valuation, okay, and then work out. Suppose you have a pre-money valuation, you will know this number. If you know this number, you will know this price, and if you know this price, you know all the prices, because the price has to be same for all the shareholders, right? So it will reverse work it. So it's this money that decides how much money you need and what valuation at which you need that money. Okay, so I think that's fine. With climate change and sustainability factors playing a role in business decisions, any way to incorporate that in Excels? Yes. So Vaibhav, what do you think? How will you include it? So if climate change represents a risk to your business, then it will show up in the discount rate, uncertainty in your revenues, and so on and so forth, right? If climate change means that people will be willing to pay a premium on your price, okay, what you will do is you will increase your price in your assumptions, and that you will factor in, you will use that as a way to look at how it's going to change your valuation. That's it, as simple as that, right? So like that you can play around with it. Okay. If people are really worried about sustainability and increase your cost, then you'll increase your cost. Like for example, if you're using plastic packaging and they ban it and you have to buy an expensive packaging, it will increase your cost and therefore reduce your valuations. Okay. Does pre-money valuation negotiations happen on a high level, 3 crore versus 1 crore versus whatever, or Excel sheet is open and assumptions are changed? Okay, so see, normally these Excel sheets are used for your backend first, intends you to get your feel. Suppose somebody says this kind of a number, any number they quote, how would you go and think about its consequences? You will need an Excel sheet for yourself. Okay, so that is how the Excel sheet is used. Now the Excel sheet, this Excel sheet in its entirety you will not present to an investor, but they will ask you for some data. They might ask you, give me your sales projections, what will be your cost structure and so on, and then they will do their own calculations, right? What they're trying to arrive at is understand how reliable is your story, how certain is it that you can make those multiples. Okay, and the valuation very often, and for whatever reason, is something they might already have made up their mind what ticket size they want to play and in what range. Okay, so they might have already decided that they will not go below 10%, or they will not go above 15% or whatever. So they know there's already a range decided. So if this is the ticket size, this is the range, then you know the valuation also, right? Okay, so keep it flexible. It depends on, don't worry too much about it. Just focus on getting the number of how much money you need to make progress in how much time frame. Get your numbers right, get a sense of, if you get a deal like this, what its consequences are, you should be able to simulate. Okay, so that's what I would suggest to you. Okay, pre-money valuation of 3 crores greater than the NPV of 2.43 crores makes sense, but the NPV was calculated DCF over 15 years. Are projections this far out common to generate? No. So see, all this is illustration for you. Okay, you can decide what is good enough for you. You can also keep changing the risk rate as it goes further away if you want. All those are complications. My point was just to point out that this is how the mechanics of it. Okay, so that you understand it. Now refinements to it, you're welcome to do. Okay, please do whatever refinements you think are appropriate, but don't spend too much time on it. It's at the end of the day, the investors only want to understand the mechanics and see whether you know what you're doing. Okay, it is not, they won't take your numbers on face value. It's very, very unlikely that they will believe your numbers. Okay, but they will believe the structure of the calculations. They will know what makes money. They will know what's going to cost money. They will know how much time it's going to take according to your plan. All of those things will be very clear. Okay. Okay, now in all this ESOPs and all will get complicated, so I don't want to get into it. But the other one I gave you, the other Excel sheet on the day when we discussed about teams, has that. So please go and look up that Excel sheet. Okay, to learn more about these. Okay, now let's move to the next part. Okay, I'm going to go from here to roughly a cash position chart. Okay, and you will see here again, I need to blow it up a little bit. Okay, so I took the numbers. You remember that in 0 year, if they have raised 50 lakhs and they have 1 lakh of their own money, they have 51 lakhs. They have losses, so the money is declining over a period of time. 3rd year onwards, it starts increasing because they have positive money. So the worth of the company is actually increasing over a period of time. So this is another calculation that you could do. In practice, you will start seeing this in the balance sheet. Okay, that it is happening as well, right? Now let's come to the last part of this. So we have done all of these parts. I hope everybody is quite clear. Pull out the sheet and we'll do this exercise now. Okay, so here is the exercise tab. You have an exercise out there as one of the tabs. What we are going to do is I've given you some numbers here, right? We are going to pull out the numbers for Violet, these Violet boxes out here. The base case is shown here. The base case as of now, calculating from the sheet, is also shown below. So if you change the numbers, the red numbers in the income expenditure statement, you will see those numbers changing below here in this sheet, this part of the sheet. Okay. And you can then note it down in the purple boxes, and I want to see what you come up with. Okay, it's a very simple exercise. What do? You go here, suppose it says the price is higher, say you are able to get a higher price of 2,000 rupees instead of 1,500. You will go to the sheet, change this price to 2,000 and note down, and when you say change the price to 2,000, right, you will see that the exercise, these numbers would have changed here. Okay, yeah, just copy paste the value or these values, not the equation, okay, into this cell out here. You understood? Very simple. Now let's do this calculation. Let's see, take about 3-4 minutes. I request all of you to try it out. We'll give you a little bit of familiarity and we'll see what happens. Okay. Time starts now. We'll hear back from you at about 7:02. In the meantime, if anybody has any pressing questions, you can put it on the chat box. Anybody lost in the exercise?
Anyone who has any questions, you can unmute yourself.
Yeah. By the way, it is a very simple sheet. Don't get too worried about it. All you have to do is just plug in some numbers and you'll get some answers. Okay. So just vary only one factor at a time. That means first I'm changing the price. So I'm assuming you're getting a higher price for your product. Then I'm only changing the sales growth rate. Then I'm only changing the tech transfer fee. Then I'm only changing the cost of manufacturing and then increasing the certainty or uncertainty. Okay. Anybody struggling with the sheet? As a general rule, don't hesitate to say you don't understand or you've lost, say you lost somewhere, because I think the idea is to learn. And so please try to figure this out. Okay, whenever anybody has answers, okay, just cut paste these purple cells into the chat box. Okay, we have some answers coming. Anybody else? Sai Prasad, something is wrong because obviously with higher price, you should be getting a higher IRR. Okay. Yeah, so the discount rate is here. Okay. So the discount rate, sorry, it's not in the assumptions, it's here, this number. Can you see it on the screen? Yeah. In G45, cell G45. Okay, so we have some matching numbers. So two people have got first one seemingly right. Okay, Tulsi has put out all the numbers. Sales growth rate is an assumption, Sai Prasad. It's in 16, row 16, E16. Okay, good. So we're getting some answers out there. So let me show you my answers and you can compare it.
Dr. Premnath, are you talking?
Yes, yes. Am I on mute? Can you hear me?
Yes, we can hear you.
Yeah.
Yes.
So can you see the answers? Okay. I think I'm just looking at the chat box also. I can see that most of you have got the answers right. Okay, great. Okay, so you can see here that what happens, right? Higher price, you get a higher IRR, and in this case, a higher NPV. Investment needed is lesser because you're paying, you're hopefully profitable a little earlier, probably catching up on the cost that you had to pay initially. Higher sales growth rate. So we increased the sales growth rate to 53%. You can see again the IRR went up, but the NPV went up quite a bit. Okay, so the growth rate, the NPV went up quite a lot. Okay. And then investment needed is roughly about same. If the tech transfer fee was higher at 40 lakhs, you saw that the NPV and the IRR came down, right, for that person. So probably, so having very stiff tech transfer terms decreases your ability to raise money at attractive terms. Okay, that's message for also some of the people from academic environments, that they need to understand that that's something which does happen. Investment needed is also higher, obviously, because you were paying a lot more here, so you needed more investment. So the guy has to plan to raise more money accordingly, right? The cost of manufacturing goes up, right? And your IRR drops, your NPV drops. So if any of these things happen, you will get jittery, of course. You want to keep this as stable as possible. So you may enter into a long-term agreement such that your price is the cost is maintained steady. And for whatever reason, let's say Ashish leaves the company, right? You have a co-founder dispute, your uncertainty goes up, your discount rate goes up, and your number starts plummeting. So any uncertainty, okay, right? Uncertainty just causes a loss to your valuation, right? Anything in if COVID happens and something goes topsy-turvy, your valuations can change, can come down. Okay, your team breaks up, you have a problem. If your contract manufacturer closes down for some reason, you have an agreement, but the guy folds, you have a big risk out there, your NPV will change, okay, will drop. So I just wanted to illustrate to you how these factors, how the sensitivity analysis is playing out on IRRs, NPVs, and the investment that is needed. So I hope this is very, very clear. So I'm going to stop here with this. This is to give you a sense of the mechanics of how your business works. I hope all of you will use this similar sheets to make your own sheets as well. So I'm going to go back very quickly to any questions at this point before I close the sheet. Okay, so I think this is done. We'll now just briefly go back to the, oops, okay, I have to share screen here. So. Okay, we have done this exercise now. You can now see whether sales are realistic. But there was a question, I think, on whether they can get you the 5x returns, right? Why don't you work that out and see? Okay, see how what would be a possible valuation they can look at 5 years from then. You can look at what will happen if, say, see, you have put down some sheet, but what if the numbers changed, right? If their predictions of sales is lower, let's say they're able to make the sales grow faster, won't the number be easier to achieve? So you can look at those numbers, you can see it. In fact, one of the cases I gave you where you're doing sensitivity analysis, the numbers are very, very attractive for that to happen. So you can work that out and see for yourself. Okay, as a thumb rule, if just in case you don't have any, by the way, there need not be any relationship between valuation and sales, but if you need to do a rough thumb rule, you can take it as around 2.5 to 3. Okay, but don't do it blindly. Okay, that means 3 times the 2.5 times the sales. Okay, as a rough number to consider. Okay, now expense. So you can look at all of these things. You saw break even was at 3 years for profitability. For investment at 7 years. You saw charts. They'll also change accordingly. And we did all of this, so I will not spend time. You can also see that by chance, if you could do good sourcing, that guy, he went and got the manufacturing partner to do it at 15%, right? It makes a huge difference to your cost if you will do it at 15% or 25%. So that's the reason that people will hunt all over the place to get the right places to do their sourcing, okay, of whatever that they want to do, or find contract manufacturers and so on and so forth. Okay. Okay, so I'll close now with a few things. One is today, I don't know if Mukta has already done this, but what we're going to give you is another financial sheet, which will simulate a services company. Okay, it's a little more detailed than what you saw. The one I used was a very, very simplified one to just get you a sense of things. And that's what I can teach in this time that's available. But this is something which you can look at and you can play around with it. Please do this for your own company. And you might need something like that to at least get some rough numbers and timelines for your storyline. Okay. So please work on it. Okay. This is worth doing. There's also another sheet, which is a month-wise plan and Gantt chart, which will be available to you. Let me just see if I can show it quickly to you as well.
I've sent it over email to them.
Yeah. Okay, great. Yeah. So let's look at. Just give me a minute. I'm just pulling out the. Okay, so let's look at this. So you will get another sheet which looks roughly like this. Let's not go into details right now. This has a sample services company. By the way, is Biodimension there today? It's very close to that in vitro testing for skincare products. Okay, so give it a shot. You'll see some trends emerging out of this. You can do your own calculations and see how it pans out. Okay, that's one sheet. The other sheet is this. This, by the way, is courtesy one of our startups. I thank them for it. Sorry, no, not this. This is. You're still seeing. I don't know why this is showing the wrong. Mukta, can you see a different sheet now?
It's the month-on-month plan.
Yes. Okay, good. So everybody, please remember that Ravi showed you a Gantt chart. Okay. So you can do a Gantt chart of this kind. And then based on this, you can do your financial projections. Okay, month on month. If you're doing a BIG project, and all these kind of things are very helpful. It allows you to estimate some of your costs, and then based on that, you can do your actuals of costing of how you're spending money month on month against your projections. So this is your projections, this is your actuals, and therefore when you're reporting to your board or tracking it for yourself, you might need to do something like this, which looks like a performance against your plans. Okay, so this is the plan for the financial year, this is the plan for the year to date, and these are the actuals, and you'll compare the two to see how much you've deviated from your plan. And that is a important thing to keep eyes open when you are building your own company's sheets. And this is extremely important for a few reasons. One, The most important is this gives you the runway straight away. Okay, so this tells you when you're going to run out of money, because this also captures grants and other money, and it tells you when you are going to run out of money and when you need to plan to raise money. So you can do that in graphical form and so on. I know Harshesh and all would be definitely be able to do a much better job of this, but this is how you could do something like this. So this also is something which will be available to you. Okay, so I think with that, we are just, sorry, just. Just 1 minute, Mugdha. Can you please hold off? Just 1 minute. Huh? I'm just closing. Can you see my slides?
Yes.
Okay. Why am I not able to go to? I'm not able to. I'm sorry, just things, too many things are open. Okay, you can see it now, right? Okay, the last point I want to make is, you know, all of you have submitted storylines. If you have not, please do. The reason we are telling you to do one more thing that Mugdha is going to send you is instructions on planning your pitch deck. And hopefully on 4th September, you'll be doing the pitches, right? Now, we want you to consider doing it in this sequence, which is do the storyline and build the pitch deck to reflect the storyline, and not the other way around. A typical temptation that everybody has is to recycle your slides. You make the slides and then try to tell your story. Please don't do that. Okay, it makes a huge difference if you write your storyline in a way that people understand and then make your pitch deck to suit that storyline. Okay, so with that, I will close and done. Thank you very much. Okay, any questions we can take up? Otherwise, people who want to leave can leave.
So as people are leaving, let